So the last few newsletters I've been writing, I've been talking about the two risks I felt were the greatest risk to the economy and the market right now. And they were effectively two things. One is the Federal Reserve. I felt last year the Federal Reserve was raising rates too quickly, and that as we didn't have much inflation, there was no need for them to do so. And clearly, economic indicators were slowing. We were seeing some global growth slowing, and that the Fed shouldn't have been raising rates. So the good news on that front is now the Fed has actually started to decrease rates, although they've tempered their language and that they'll be data dependent, of course, looking forward in their future interest rates decisions. So that's good news that risk is now clearly off the table. But the second risk is the trade wars and tariffs. And the trade wars, I think, are going to go on a lot longer than most people think, and I think well into next year. So this is going to be an area where we're going to have continued volatility, and we've already seen it this year where the market will rally on news that there may be some a truce of some sort and that there'll be a deal done, and then sell off quite harshly like we had today when it looks like that the war is going to go on longer. And what I like to do often is kind of break things down and make them a little bit more simplistic and take a larger macroeconomic situation and break it down to a smaller one so we can kind of understand and set better strategy and keep our heads when we have this type of market type situation. So I thought I'd bring in our old friend Arnie here, who of course is our mascot. Let me fix his hair. And as a good example of how tariffs impact an economy. Now, I pay $8 for Arnie. And of course, we give him out free to our clients. And he comes over on a slow boat from China, and he makes his way over to the offices at Altrius. And of course, Arnie, if a 25% import tax is placed on Arnie, then I'll have to pay more. I'll have to pay $10 for these Arnies. Instead of when I buy 1,000 of them and costing $8,000, it'll cost me $10,000. Now, we don't sell Arnie to our clients. We give them out freely for their children and grandchildren who seem to enjoy them. And of course, he represents our strategy and style of investing with his approach in that he collects the dividends and doesn't worry about the volatility that we have right now. He goes out alone and unafraid into the dark of the night, working in a night like tonight, when others are scared and hiding and holding away, and he works diligently and thinks about these things and doesn't panic. Now, when Arnie comes to America from China and costs us more, two things happen. I either have to pass that cost on to the consumer, to us, or I have to have less profit margin, right? So the company would make less money because of the additional costs in Arnie. And this has had a negative impact on our economy here in the short term. Hasn't had an inflationary pressure yet to the economy, so things aren't costing because things are working in the sense that they're getting pushed through and businesses are doing a good job of controlling their costs, and we're not seeing an inflationary pressure yet. And of course, if you have global growth slowing, then we have less hiring and we have less buying, and that also keeps inflation in check. We see oil prices going down like we have recently. So all of the good that came from the tax reform package of a couple of years ago, where each American citizen has benefited, let's say on average of $800, has been negated by $800 of additional cost. And where that puts us is at about a 2% GDP again. And 2% GDP is fine. We've made a lot of money over the last decade. It's not great. It's not ideal. Excuse me. It's not what we want. However, we've done quite well in a 2% environment. And I think we can continue to do well in a 2% environment for the companies that we're invested in. So it's important to kind of think about it from a mathematical standpoint. There's really no impact to us longer term or here even in the short term. However, there is, of course, an emotional impact. And what I mean by the emotional impact is that in the short term, people could freeze up. They could not spend, businesses don't hire, they don't invest more, and when that happens, that also has a negative impact on the economy. So I could go on Bloomberg or CNBC today and say that I think the market is going higher, or I think the economy is going lower, or into a recession. The reality of it is that nobody knows. And as Warren Buffett says, is that prognostications tell you more about the prognosticator than they do about the future. Nobody knows, right? No economist knows, no pundit knows, no financial advisor knows. And that's why right now we're just at a little over 50% for our equity allocation for the broad majority of our clients, including my own personal assets in our retirement plan here at Altrius, which is invested side by side our clients in the same stocks and bonds that our clients are invested in. And that's effectively because the risks I look at is quite equal. When we do scenario analysis, I look at the worst case scenario and I say, you know what, the market could go down 25% over the next 5 years if we're heading into a recession. Or we could do quite well. We could make 10% a year, especially when you look at the valuation of international stocks, which are quite compelling right now. The truth is somewhere probably in the middle. The 5% yield, 6% yield that we're getting from a lot of the bonds we're investing could outpay stocks, which is why we're investing in the types of bonds that we're finding. And it could be that U.S. stocks continue to outperform as they have this year. So when you have this type of environment, you really don't want to look at it from a standpoint of what's happening in the short term and try to time the market. We want to set the allocation that we have. Think as long-term investors like we are, understand that we're invested in 50% stocks, 50% bonds, and that the risks and the reward potential is effectively equally weighted at this point, and that we could have a snapback at any time too, and not try to game exactly what's going to happen in the market or the economy in the short term. We have to think longer term and invest like the Aardvark. Think about those dividends that are coming in, claw deep for value, keep our ears up for the risks that are out there right now. Be sensitive to them, but be prudent in our actions and don't try to go out there and change things and make rash actions at all and thinking long term. Understand that this year we're still up and the market's still higher, and even though we're not as high as we were a week or two ago, it's okay. We're long-term investors and we're not going to act irrationally based upon a particular movement today in the market or a tweet or something that's going on, even from a geopolitical standpoint. So as always, if you have questions, feel free to call us. Today I got a call from a client saying, "Oh, you must be getting so many calls." I said, "No, you're the only one actually who's called today." And that's not unusual for our longer-term clients who've been through much of this type of volatility over the past 2 decades, and including a horrific financial crisis, a dot-com bubble. Our clients have not had to change their lifestyles or go back to work during their retirements. They just kept collecting their dividends and remain invested and not sell the stocks that we're invested in. But if you have questions, as always, feel free to call us. Don't hesitate, please. I understand the trust that you put in us, and I'm very thankful for that. And that burden is not one that we take lightly at Altrius. So we deeply appreciate your trust, and let's stay invested and keep our heads in these volatile times that we're in. All right, thank you.